All right, everyone. For our second panel, we're going to hear from the platforms. In the spirit of agency collaboration, my partner and lead moderator here is Jill Summers, former CFTC commissioner. So Jill, take us away.
Great. Thank you, Jamie. Thanks to the CFTC and SEC staff that have worked hard to make this roundtable possible today. I think it's an incredible opportunity that we have today to talk about issues of harmonization. And obviously the importance of the issues to the markets is demonstrated by the caliber of participants that we have here today. I'm going to jump right in to our agenda today because we don't have a lot of time. We have a lot of important issues, and I think probably everyone up here has a lot to say on all of these issues. We're going to jump right in with regulatory structures. As everyone here today knows, the U.S. has a unique regulatory structure for oversight of securities and commodity derivatives markets. We would like to discuss how the different statutes create challenges to harmonization and to streamlining the process for coordination between the two market regulators. And I'm going to kick this off with Jeff Sprecher from ICE.
Thank you, I guess. First of all, I want to commend chair and acting chair for pulling this group together and for the staff that actually had to do all the hard work. And thank you, Commissioner Summers, for hosting. By way of background, my company owns multiple U.S. securities exchanges, multiple U.S. options exchanges, a designated commodity marketplace, a designated clearing organization, a securities clearinghouse, multiple foreign boards of trade, multiple foreign clearing organizations, a CEF, multiple ATSs, a broker-dealer, a swaps data repository, and a custodial trust, all of which are some way, shape, or form regulated by the SEC, CFTC, or with foreign regulators in collaboration with the agencies. So we deal with a lot of interagency differences. What I really, the gist of I think my company's comments are that not only has it been hard to work interagency in past administrations, it's been very difficult even within the agencies to have consistency between market participants. For example, many people don't realize that the U.S. security exchanges are not able to trade in notional value, which is what many market participants want to trade in today, because it requires that we have fractional shares and sub-penny pricing, which we're not allowed to do. The securities exchanges are required to clear through DTCC, which offers T+1 day settlement for cash instruments, and only during U.S. banking hours, requiring that the exchanges operate essentially in U.S. banking hours. There's no such thing as NYSE Direct because it's not allowed for a market participant to trade directly on a securities exchange. You must be a FINRA regulated broker-dealer. There are no exchange owned or affiliated market makers or trading arms to help launch new products because that's not allowed. There is no access directly to the clearinghouses by retail or market participants that want to use margin. So much of the innovation that's happened in my mind that's I think at the root of stimulating this well received conversation that we're having between agencies is that the innovation has been happening around DeFi, around blockchain, around tokenization, and entrepreneurs, like Shane and Tariq, who have started relatively new marketplaces, have been able to use those technologies to overcome some of the regulatory hurdles that I'm mentioning to you, and I would say both gentlemen have gone through significant personal sacrifice to get to where they are today, and sacrifice that that the public exchanges up here couldn't tolerate. We cannot tolerate receiving a Wells notice. We cannot tolerate the FBI showing up in senior executives' homes, and because our shareholders will not allow that. So I hope that that not only can we find ways of harmonizing the CFTC and SEC, but across those two jurisdictions, we find ways of harmonizing all the different innovative technologies and exchange ideas that are going on within the space.
Thank you, Jeff. I think it's important to sort of level set with those types of comments, and I'm sure others at the table can chime in. Adina, if you'd like to chime in as well.
Sure, thank you. Well, I would say that, Jeff, that was an excellent start and, nice and fiery start to get us going. But I would agree with what Jeff has said. I think that it is interesting to see how market structure in the U.S. security space has really been calcified, I would say, for the last 20 years with Reg NMS. So it's a very, very, very distinct and very structured regulatory landscape. Yet within other parts of the regulatory apparatus, it allows for a lot more flexibility. So it would be nice to see some harmonization. And I think that what we would strongly encourage is a concerted effort across the agencies to come up with clear outcome-oriented regulatory framework that is harmonized across the agencies. One concept that we have is the idea of having both agencies come up with what we would call platform construct, so that we would have a similar regulatory oversight of a platform, regardless of what asset class is traded on it. And then each of the agencies would have specific product-based regulatory oversight over specific asset classes and products to, as to whether or not they're securities or commodity futures. So it is, I think there's a way to do this to create harmonization to allow for more flexibility of the platforms themselves to have different opportunities to engage, to innovate, to experiment, but then also still have oversight over the securities that you are in fact, or the asset classes you're in fact tasked with. The second is to really create that level playing field. Whether you're an established exchange, as Jeff had mentioned, established exchanges have a lot of restrictions on them versus new entrants. So how can we create a level competitive playing field so that we all have an opportunity to innovate? I mean, this is like a seminal moment. I've been in the industry for 32 years. This is a seminal moment for the two agencies to come together and actually start having these conversations in earnest. So we're very excited about it. We do want to make sure that investor protection stays first and foremost in the minds of all of us as we are structuring these opportunities to work together. But if we can do this in an innovative way with obviously all the technology that's available to us today, we think that we can do a lot of great things together. I'll give you one example where we're just finding we're stuck between the regulators today, and it's a good tangible example of why we need to find better harmonization. We've been asking for several months now to approve something called the NASDAQ Bitcoin options. It's called NASDAQ Bitcoin Index options. But it is essentially, think about it as a security, as an option on a commodity. And I think the challenge has been getting the two regulators to figure out how to harmonize and work through the issues of allowing a security on a commodity to trade on a securities exchange. And we are just finding we love the idea of this task force being formed to find our path forward for something like that. That's a real innovation that investors want and are demanding. Is not going to introduce undue risk, but is something that's just falling in between the two regulators. So excited to have this engagement, and thank you very much for bringing us all together.
I encourage anybody else, if you have comments on this topic, to jump in. If anybody else wants to address any of the topics on the regulatory structures, if Terry or Craig.
Good afternoon, and thank you for inviting me to be part of this. Thank our hosts and thank our fellow panelists. Jeff, you mentioned they've had to endure FBI raids and Wells notices, but you forgot to mention they had to wear ties today, which is equally oppressive, and we should find a solution to that. But I thought I would just weigh in a little bit on, some of the things that have been talked about in the prior panel and that we'll be talking about here. We continue to see amazing innovation in our markets, not just product innovation, but innovation in market structures, innovation and technology applications that are used by market participants to interface in our markets. And, to the comments that were made on the prior panel, for those of us that have been in the industry for 35 plus years, these are not new issues. These difficult jurisdictional questions are ones that have always been around, and I'm afraid they'll just accelerate now, given the pace of innovation and change that we see in the external landscape around us. But I do have some specific suggestions, and I do think that it's very important for the two agencies to act more quickly and to speak with one voice on jurisdictional questions related to product innovation. And I think part of what could be done is to also place more responsibility on registrants to actually articulate both legally and economically why their product belongs being subject to the CFTC's jurisdiction or the SEC's jurisdiction. And I think, while there are review processes that each agency has, if there could be established a joint process that is expeditious and results in an earlier outcome for market participants, that would certainly be very beneficial to allowing people to keep innovating, bringing new products to market. But I don't think it can be done episodically. It has to be something where people can bring that to the attention of the two agencies. The two agencies could perhaps have a joint adjudication process, and also one that's just done more quickly without extensions and without, half-year reviews. So I'd love to see something like that happen. Unfortunately, in the past, we've had the issues with commodity-based ETFs, the spikes volatility products, and oftentimes those things only get resolved after litigation, which is way beyond when it should have been rectified. And so, looking at those issues is very important. Obviously, as Ken Benson talked about, we live in a world where we have congressional grants of jurisdiction. Those are not likely to change, but we see security-based products that are being traded as though they were futures and subject to CFTC jurisdiction. So we have event contracts, for example, that are on pace to trade probably more than 100 million contracts in 2025 that are based on the S&P 500. It's hard to reconcile how those are not, both in legal definition and also economically, a security product that belongs on a SEC regulated exchange. Those are the kind of issues that need to be more promptly adjudicated by the two commissions.
It's a good point, and one that we have talked about, where there are several areas actually in statute where the agencies are given joint jurisdiction. And the previous panel talked a little bit about how that worked out with single stock futures. It's not always a seamless process, and it's usually not successful outcomes for different market participants. So those kinds of suggestions on how the agencies can work together are certainly welcome. And basically that's what this roundtable is about. Terry, do you have any comments on the joint jurisdiction?
Well, on a joint jurisdiction, it seems like it has never worked, for starters. And I think I agree with some of my colleagues here. We need more clarity. And I think that the agencies themselves, and I know Jeff feels passionate about this because I heard you're on the call the other day, that, in order to get efficiencies throughout organizations, we need efficiencies within our own regulators. So once we can get a streamlined process where we all know the rules of the road, it will be much easier for the participants. I think the worst thing to have happen, Craig kind of touched on this a little bit, is to allow a product out the gate and then have the participants going at it in a certain direction. And then all of a sudden there's a change either at the regulator or somewhere else where they have to pull back, relocate, bring it into a different regulatory environment. It's very disruptive for innovation. You talk about some of the folks up here that are innovating products. It is truly essential that we continue to innovate new product, but at the same time, if the participants do not understand what the regs are associated with it and they change from one reg to another. I'll give you an example. One-day self-certification is a great example of this. One-day self-certification is not an approval. One-day self-certification is not an objection. There's two different things from that. And so a lot of the people who are participating in products don't understand that. So if we want our markets to grow, to become more efficient, you better make sure the participants understand that as much as the agencies do, as much as the institutions and the platforms do. So that's kind of how I look at it, Jill, I really think that harmonization is a really nice word to have. Efficiencies is a great word to have for your shareholders. But in order to have innovation and make it not one step forward, two steps back and continue to go forward is to give clarity to the participants. And I think that we've missed that to a great degree. Craig touched on a little bit with certain products that he feels that are securitized, not commodity type products. And you can have that debate, but we should have it before we get the product launched. It seems like a little bit of a ready, fire, aim strategy than a ready, aim, fire strategy.
So the product approval process is definitely one of the ones that I think is ripe for us to talk about today. And so I invite any of the platforms to talk about what you think the pros and cons of the approval process is.
I'll take this one. First of all, thank you, Chairman Atkins, and thank you, Chairman Pham, for your leadership and for having us today. It is really refreshing and inspiring to see how far we've come in terms of regulators willing to have us here, willing to have us engage. And I'm extremely optimistic about this effort and look forward to today's first step. I'm Tarek, I'm CEO and co-founder of Kalshi, the world's leading prediction market. Kalshi got set up in 2019. We spent years getting prediction markets approved by the CFTC. Got the DCM in 2020, unanimous approval, and we operated the exchange for a few years in what I would call, and I'm being coy here, a harsh regulatory environment for prediction markets. That environment ended up with us suing the CFTC, our primary regulator, and we did prevail last year. Thanks to this lawsuit, in some ways, prediction markets have gone, I would say, more legal, regulated, mainstream in the U.S. And there's kind of a new category being established as a new financial instrument that we're very excited about. Kalshi oversees more than 4 million retail participants today, and a large ecosystem of market makers and financial brokers. And today we're doing around 40 billion of annualized volume and becoming a meaningful player in the retail derivatives markets. I'm taking this question because it's a very relevant question to us. So over the last 4 years, so we've listed the most number, I think the largest number of markets in the industry. So in 2021, we did 124 markets, 22, 90, 23, 133, 2024, 687, and 2025, we're at 1,364. I think we're probably on track for 2,000 this year. We're trying to push 3,000, but we'll see. The thing that's interesting here is, in 2020, when we sort of in 2019, actually start approaching the CFTC about prediction markets, I mean, this was a very bizarre niche corner of the internet. We were really people looked at this as a very small part of markets. And it was also a time where retail was not I would say it was an important part of markets, but not what we're talking about today, not the sort of scale, unprecedented scale that we're looking at today. I think we have come a long way, obviously, both prediction markets, but I would say even more importantly, retail derivatives, broadly speaking. And, there's kind of an umbrella, I would say, for these products now to progress and thrive within the CFTC's umbrella. But as we sort of think about the next frontier, for us, I mean, I think I do agree with you. I think security adjacent products and then even sort of security futures become sort of a priority given the sort of size of the markets and the interest in retail, for retail. Obviously, there's also the rise of perpetuals, which is another sort of question. And I think there's sort of three sort of pertinent issues that sort of holds back innovation today. One is there is legal uncertainty, which is much more difficult for you guys than it is for us. That's a fact. But in many ways, even for us, it does force innovators to be making educated guesses about which laws applies and, which basically makes it hard to have a compliance first approach. And as a company that's really focused on regulatory first approach, it has been historically hard to operate in areas of uncertainty. And often what happens is, if you go to agencies, we get long answers and the agencies often disagree. So what companies are left with is sort of waiting for regulatory clarity where some of the innovation is pushed offshore, which is not ideal for America. We hope that the sort of harmonization effort does disentangle some of these disagreements in the rules or interpretation of the rules. On the approvals piece specifically, SEC regulation, like Terry said, is an approvals process. The approval process, though, does take 240 days, I think, for a lot of the products, which is a very onerous product for a world where retail is asking for increasingly more dynamic products. They want things on a monthly, weekly, sometimes daily, sometimes even hourly basis. People look at something on Twitter for an hour and then they forget it and then they look at the next thing. So the world is evolving, and in some ways we need sort of some of these rules to evolve. So we are obviously big fans of self-certification as a company. The last piece that I'll touch on is direct access. I do think today there's a little bit of a disparate treatment. On the CFTC, there is direct access. On the SEC, there is not. Direct access is important when it comes to retail. And, you know, I in some ways, you guys are hampered without sort of the existence of direct access. So we're excited about the harmonization effort to figure out ways of enabling direct access on the SEC front, whether it's rulemaking or exemptions for limited sets of contracts. Thank you.
Does anyone else have any comments on the actual approval process?
I mean, an integral part of the approval process is figuring out the cross margining often, and historically, the cross margining issue has taken forever, or in many cases not been approved. So right now we're moving towards cleared repo, and it's essential that the cleared repo for treasuries get, at the DTCC, FICC gets cross margining with treasury futures on CME, for instance. And I think obviously there are different bankruptcy regimes, which complicates the topic, but these are generally professional market participants that are comfortable, if they say they want to sign up for cross margining and therefore they're subject to the CFTC regime. I don't think that it's appropriate for the government to tell them that that's not safe enough for them.
Jill, if I could just add, I think the two product approval processes at the two agencies could not be more different. And I think if there's an area that really needs to be harmonized, it really would be that process between the two agencies. The process under SEC Rule 19b-4 is exceedingly burdensome and lengthy. The more principles-based approach at the CFTC has always been, I think, much better, although I'm going to agree with Terry that I think it's gotten maybe taken too far and abused in some cases. And so I feel a little bit like Goldilocks, which is one is way too much and way too cumbersome and way too impeding of innovation and progress and bringing things to market. And the other one is kind of like the wild, wild west with no speed bumps, no checks and balances. I'm not even sure anybody even looks at them. And so if we could just find a way to harmonize the two processes, and I think it's really important because to the credit of, some of the, newer organizations on this panel, there's a lot of interesting innovation that's happening, and we want that to happen. But what we don't want is we don't want people to design products to take advantage of what could be perceived as an easier system. We want people to design products that have utility and merit to market participants and customers, and not to sort of design them to sort of fit within one structure. Like many of the other large exchanges here, we operate, in both areas. And a lot of the type of products that we innovate are at the intersection of the heart of this very problem. So if we could try to figure out a way to actually structurally address that through harmonization, simplification, and just strike the right balance between, not impeding progress, but at the same time, not impeding, people's ability to actually bring products to market.
Yes, of course.
I think the sort of the biggest issue that I look at is like, how do we just learn from the past? You take a look at like Dodd-Frank and what we went through, and I guess what we're still going through it today. And then the sort of second notion on that is, I mean, we're cracking, we operate globally. I guess we're technically not registered in the US yet, but Australia, Canada, UK, Europe, and now even parts of most of Asia have already kind of figured this out. And we're playing catch up a lot. And so most of the innovation is continuing to happen outside. They have their innovation exemption sort of rules already started. I mean, it's hilarious that out of all the countries or regions that have already started to innovate is Europe. We kind of make fun of them, but they're ahead of us. And so, we're talking about token classification. What do we do? Market structure, restrictions. And then what are the type of assets that are going to be classified under those tokens, outside of meme coins, BTC, ETH, and, how we think of traditional commodities. But, just having just utmost clarity so that we can start thinking about cross margin, so that we can start thinking about, how do we think about adding a security on top of a commodity, which could be a token. If we have clarity, we can actually innovate. It's hard to innovate if there's no clarity whatsoever. And so my biggest fear is that we just continue to see rapid acceleration, rapid innovation outside the United States. As a company, we've already been forced to build outside the United States, where tokenized equities is already launched, rest of the world and in Europe. We don't have any clarity here in the US yet. We're still talking to the SEC, and of course, we're in a sort of a new world. But as the world moves forward, we're still moving backwards.
Yeah, I think those are all really good points and takes us kind of into talking about these exact same issues, product approvals, and how the agencies deal with these different kinds of products, defining them, and whether or not it's appropriate to consider exemptive authorities. So does anyone have comments on where the agencies could go with with authorities that are to some extent already granted to them in Dodd-Frank, and how they could use the exemptive authority to move forward with these things? Adina?
So you're talking about innovation exemptions and other things like that?
Yes.
So first of all, I agree with Craig very much on how he defined the Goldilocks situation. But having spent my life under the jurisdiction of the SEC, I only wish that we had the CFTC as an opportunity to, I'm sorry. But, in terms of being able to launch new products, self-certification sounds pretty good.
Adina's gonna have to wear a tie next year.
But it is interesting to hear. I agree with that in terms of striking the balance. In terms of innovation exemptions, it is important for the to remain competitive in the global capital markets. And I think that Arjun really described it well, that we have the deepest, most innovative, most interesting capital markets in the world. And we are the envy of the world. We provide technology to 130 other markets around the world. And it is remarkable at how much they ask us, how do we create the magic that sits inside the United States? And so we want to make sure we remain there. I mean, that should be our goal as regulators, as platforms, as legislators, I think, to make sure that we maintain that. At the same time, I think part of the reason why our markets are so strong is because we really do focus on investor protection as one of the core tenets of what our role is, both as platforms and as regulators. And so as we think about innovation exemptions, I think we have to first start with the North Star of the investor. What is actually going to provide a new benefit and opportunity for investors, but also be cognizant of the protections we have to put in place? And yes, we are very pleased to have the retail engagement that we have in our markets today. It's really remarkable, and it's drawn a lot of growth. But we also have to make sure that we think about, as we bring these innovation exemptions, that we don't do it just to support a certain business model or a certain, innovation for innovation's sake, but we're actually bringing something that we think will benefit investors. And we would ask that the regulators work together to think about that as a core tenet of this task force. We also think that we have to be careful that it isn't a way around a rule. Rules exist for a reason. Now, some of them may have outlived their purpose. Some of them may be that we have to really rethink the rule itself. But, and we do use pilots and other mechanisms within the SEC to try to drive some innovation. But if you're innovating just to skirt around a rule that exists, let's make sure we understand maybe we should change the rule as opposed to just allowing an exemption. And then the last thing is, of course, with exemptions, as a platform, and Jeff described it well, as a securities market, we cannot operate an ATS that's not considered an exchange. ATSs have to be considered a facility of the exchange, which essentially makes it so we can't really run an innovation ATS. We'd like to have that flexibility. So there are some things that would be really, I think, game changing in our ability to innovate. But I would only ask that we do that in the construct of, why does the rule exist? Should it be repealed? If a rule exists for a certain asset class but not for another, why is that the case? And then allow for those exemptions to occur for the benefit of investors and not just for the benefit of the platforms.
Great. I want to make sure that I ask Shane if he has any comments about whether it's on the product approval part or the innovation exemptions and how that would affect your platform.
Yeah. First of all, thank you for having me. to Chair Atkins and Acting Chair Pham. It means a lot. I was worried when I showed up here, they were going to whisk me away to another room. I'm glad I'm here. So I'm CEO of Polymarket. Polymarket is a prediction market. Some of you guys may have seen it. You've maybe seen the odds. It is built on a blockchain. As we are all very familiar, once you build something on a blockchain, it's very difficult to map that to the existing regulatory matrix. And I think that's where exemptive authority comes in. And obviously, you know, as much as there's willingness and sort of openness to do it in terms of some of the speeches that the regulators have been that have given, it is very difficult to go and map building an on-chain product, a DeFi product, into the existing regulatory matrix. So we recently acquired a company called QCX, which you know, now we own a DCM and a DCO, which is a great first step. But there are a lot of benefits to building on-chain. There's transparency, there's composability, interoperability, among others. And, you know, very luckily, like companies like Polymarket have gotten to the scale where we can really invest in GR and regulatory and compliance and being creative. And, you know, I think that it's pretty clear with this administration that we want the regulators to cultivate DeFi. But at the same time, you know, where exemptive authority comes in, the innovators know about, okay, how can we go and build this? How can we go and implement a smart contract that provides us investor protection a lot better than any regulator is going to know, obviously. And I think that puts the onus on players like us and other players in the space to go and get inventive, do what we do best, be innovative, and come up with solutions that both embody the sort of spirit of the rules that you see in traditional financial regulation, whether that be with the CFTC, the SEC, with what's capable of the technology, so that you can come up with, hey, we can abide by this, but this is going to be impossible or very difficult to go and map from a smart contract-based architecture to sort of the architectures that are applicable to the existing regulatory matrix. So I think that that's something that is sort of the solution if we want to go and bring on-chain finance into the States. But I think it starts with collaboration, people on both sides of the aisle talking with each other, coming up with ideas. And one of the reasons we're here, so grateful to be here, is you know, we're ready to have those conversations.
Let me just jump in for a second. I know Jeff and Adina can handle themselves, but I really like to understand why that when innovation becomes an exemption, which is essentially the same products that core institutions have been trading for years, they're just lookalikes with a different name to them, that they would be exempt and core institutions would not be allowed to do the same exact thing. Or if they are, it's definitely not on the same exact timeline. And if you're not first to market, you might as well not go to market because you're never going to be successful. So I appreciate the innovation up on this panel, and I think it's critical to the future. But you cannot have a double standard, whether it's in derivatives or securities. You have to have a single standard. So when we talk about these innovation exemptions, a lot of them are just the exact same products that are being traded today under a different name, under a different regulatory regime. Maybe you can't make it fit on the blockchain, but that's not the problem of the core institutions that have been doing business forever. Allow us to do it just as well on the same speed. So I really think it's important that we have a level playing field, whatever it is. I always have said, I will play on any regulatory platform you want. Adina said she wants to be registered by the CFTC. I had an application that Craig is well aware of from 2015 that sat at the SEC for securities clearing for 6 years, and I pulled it. 6 years. I mean, how is that speed the market when other people want to do things overnight or on a one-day self-cert, whatever the case may be? We need to have a level playing field. So if you want to talk about harmonization, you cannot take away this innovation exemption and say, that's okay, but let's have harmonization against everybody else. So I think it's really important to level set that. Love innovation, love it. Can't go forward. I just did the deal with FanDuel. As you know, I'm all in on this stuff. At the same time, you can't exclude incumbent players in a different way.
Yeah, I totally hear you. I think if you take a step back, right, so the regulatory agencies have exemptive authority, and the admin has made it clear that they want to win in decentralized finance. They want to win on blockchain. And really, you're at a fork in the road where, hey, I can either go and wait and lobby and do rulemakings for 5 years while everything happens offshore, and we're left with consumers having to you know, work with guys like you who are a lot older, may not, with all due respect, but may not understand, may not understand the demand. Yeah, they may not understand the demand of modern day investors, right? So, if you put those two things together, right, like, it's like, do we want to get left behind, right? So I'm not here advocating for, hey, give us a free pass to go and compete in a way that the CME cannot. I think that if you want young entrepreneurs to pursue the American dream, to innovate in American finance and build products that can be competitive on a global scale as well as in America, it's net negative to go and from a regulatory perspective drive that offshore. So I think that, and just to round that out, I'm not saying, hey, go and let people do whatever. I'm saying, it's going to take people like Polymarket and other sort of players in decentralized finance to go and be thoughtful about, hey, this is something that we can comply with, and this is something that, given the architecture, is something that needs exemptive authority. So I'm not asking for blanket approval, but when there's new technological innovation, when there's disruption, when there's paradigm shifts, the American way is to go and embrace that, as opposed to wait years for it to play out. And I think that's what it's all about.
Yeah,
I just want to state for the record that if Shane winds up in a room, it may not be the government, maybe some folks from Chicago.
That's usually the way it works, Jamie.
If you guys can't find me after this, someone call my lawyer.
I just want to add to that, because I very much agree with both Terry and Adina, but I just want to say, I mean, we're not lacking for innovation. We have the most innovative financial markets in the world. Name one that is more innovative than us, and we've never really lost. And
We're losing right now.
But we're not anti-innovation. But the point that Adina made is a good one, which is, you could look at Reg ATS 20 plus years ago as a type of exemption. Okay. And it had all the best intentions, right? It was going to reduce effective spreads. It was going to create growth and more efficiency in securities markets. And yet here you have today, not to speak for Jeff and Adina, but I think you'll agree with me, we're trapped in the old paradigm. We can't actually compete in what is now the majority of trading activity in cash equity securities in the world's largest cash equity securities market. We can't do it because we're in the exchange paradigm. And so that is the falsity of innovation exemptions. And Terry said it perfectly right. If you're going to do it, it has to be for everybody. It can't just be for the new people doing new things. We're all doing new things every day. So we want to join you in that. If there's an opportunity to be more successful, let's all have at it. We'll all be great competitors. We'll all be great innovators, but it shouldn't be that we're trapped in the old paradigm and there's an exemption where everybody can do whatever they want. And the other last thing I'll just say is it's not just about innovation. All of us would agree, at least all of those of us who spend our lives in financial markets, it's not just the quality of innovation, it's the quality of regulation. We are successful because of the regulatory structure, despite our imperfections, all of which we're talking about today. But people trust our markets because they're trustworthy. We have market quality, we have market integrity, we have platform resiliency, we have safety, investor protection, we have all those things. Let's not lose sight of that.
Don.
Okay, so I should probably start off by explaining why I'm sitting here, because I think a lot of people look at me, know DRW as a trading firm, and I'm here on a panel of platform leaders. The reality is that we've been involved in product design for a very, very long time. And we've launched a number of platforms. Most recently, we launched a spot market for GPUs, and we're working towards creating some kind of a tradable GPU futures contract. We got into the crypto space before really anybody else. We started Cumberland in 2014 and have created all sorts of products for our counterparties to interact with us in that venue. At the same time, one of the things that we were very excited about, in 2012, when we were having the internal debate about whether Bitcoin was interesting or not, and I think that common view was that only criminals were dealing with Bitcoin. Our view was that blockchain, if applied to traditional financial markets, had the opportunity to make them far more resilient and efficient. And so we started a company called Digital Asset Holdings in 2014, which created the Canton blockchain, which is purposely designed to facilitate what we need in traditional financial markets. That which I do believe most people in traditional financial markets still want to be able to transact with privacy. But at the same time, the Canton blockchain enables composability. So as we think about these innovation exemptions, I'm very much in favor of innovation. I think that it's important that we move faster, and that we give the United States the ability to catch up with what's happening offshore. But at the same time, we need to be very thoughtful about how we do this. And so, for instance, when we think about equity tokenization, this is not just a one size fits all the same thing. And there's some tokenization that's happening right now, which is a company buys a stock, or supposedly they buy the stock, they issue an IOU on a chain, and then they say, okay, voila, we've tokenized this equity, have at it. That's not the only way that you could tokenize an equity. A company could, of course, issue their own equity on chain. Would be another way of doing it. Another way that could happen is the DTCC could issue an equity on chain. And what's really important as we think about this, and we think about these these innovation exemptions, that we don't wind up with a fragmented market, that we don't wind up with a situation where there are private verticals that trade one flavor of a token in a stock that's not fungible with, first of all, that trades outside of Reg NMS. I'm not a huge Reg NMS fan, but if we want to stop Reg NMS, let's review Reg NMS. Let's not do it through an innovation exemption and create these kind of side pockets. But even more importantly, let's make sure that all flavors of tokenized equities are fungible with one another. If we fail to do that, and we wind up in a situation where shares in a given name trade at different prices in different markets, and there's no efficient mechanism for liquidity providers to collapse and offset those positions, then we have done a huge disservice to the investing public, and that's what we should be thinking about first and foremost.
Arjun, would you like to speak to us about that?
Yeah, I think I think it's really easy to say, let's not have innovation exemption and level playing field, but like to have level playing fields. But I think what I sort of take issue with is that for so long, the regulatory barriers have been monopolistic. So it's very hard to innovate in the first place. So I don't want to speak for Tariq or Shane, but or even in our case, what we had to go through to get to where we are now was also just as painful. And nobody likes having the FBI knock on your door, or DOJ, or a Wells notice, and who knows when it's coming. And I think what's more important here is that if you take a look at what's happened since post-World War II, which is where we sort of continue to argue with, which is like, hey, we have these efficient systems, we've had the world's best capital markets. Yes, things are changing very fast, where people are coming onto the internet every single day, mobile, etc., and they're demanding products, and the products that they want to get access to are very familiar and similar to what we've had here in the United States. And they're just going to replicate it, and they are replicating it without us. And so, yes, there's so many versions of tokenized equities. Of course, you're seeing crypto coming into the ecosystem, on-chain DeFi. I think you could innovate. I mean, I don't see a world where you couldn't have innovated outside the United States if you wanted to. You have plenty of cash flow. You've got plenty of smart people, much smarter than we are. And we're saying the same thing here, which is like, we also want to innovate. I would love to list a company on chain and on our exchange. We'll most likely do that outside the United States first, based on the speed at which we're going. But I think to say that, you guys want to be on a level playing field is just that. You should be on a level playing field. And I think to a certain extent, that you guys should be pushing in the same direction, the same way we were 4 years ago, or 8 years ago, or 10 years ago. And I don't think the argument about, financial markets looking the same is any different than, hey, we want to win in AI. We want to be the first here in the United States. If we don't push in this direction, we will lose. And we're already on the cusp of that. And so, I commend what, Tariq and Shane are doing, obviously what we're doing, but the whole point of, even the Bitcoin white paper and this whole movement was, how do we get access to capital? How do we get access to the same products to the individual person that, rich people get on a daily basis?
Can I just want to respond to that for a minute. First of all, I don't think that we are saying we shouldn't have any exemptions. I think we should just understand the underpinning of why they're being proposed. And I'll give you, I think I'm going to build on what Don talked about a minute ago. We are, as an exchange operator, we have a lot of rules that govern the trading of U.S. securities and U.S. stocks. And some of them exist for very, very good reasons. And some of them, it would be nice if we had more opportunity to expand our remit. It is highly competitive. There's no monopolistic element to the trading of U.S. equities. It is, a knife fight for every order. But I would also say, though, that what Don talked about was, this idea of tokenizing the equity. It's not the underlying equity that's being tokenized. It's a derivative of the equity. It's in fact, equity is being held separately and taken out of the liquidity of the market, being put into a pool, and then a tokenization on a derivative or a derivative tokenization that may not even confer the same rights to the end shareholder that the underlying equity provides, which they may not even have an understanding of. And so I think that there's also all of the trading that happens in the derivatives does not go back into the tape. And while the consolidated tape has a lot of issues, we could spend a whole day on challenges of the consolidated tape, it serves an incredibly important purpose for investors around the world. There are 7 billion people around the world who follow the tape and understand the trading of U.S. equities, every order, every trade. And it really, it's kind of not every order, sorry, every trade. It's one of the things that I think is a cornerstone of why our markets are so deep is to have that access to instant access to an understanding of the market. So I hear you, and I do want innovation. I'd love to have it so that we can innovate beyond price time. I'd like to be able to have a price size market. I'd like to be able to be an ATS and be able to segment, flow, and to have more opportunities to show that we can provide new benefits to investors. If we can use innovation exemption to do that, let's talk about it. But I also would say let's look at the underlying reasons why there are things that exist a certain way and be thoughtful about it. So it's like kind of a little bit of the Goldilocks. It's like what should make it so that we can go a lot faster than we can go today. But also let's make sure we're always thinking about how are the investors impacted by what we're doing.
Those 7 billion people that you talked about haven't had access to any of these markets.
Well, actually, they trade. First of all, we are going to try to bring it 24/5, so they have a lot more access to those markets, right? That's one of the things that we're really working towards. But a lot of them go through members to trade in the U.S. But I would agree that we can expand what we're doing to make it so that they have more access. But that should be done through a purposeful effort and without having to hive off CUSIPs from kind of underlying equities and trade it a different way. That's what I really mean.
I think just want to jump in on this. I just want to clarify our position a little bit on this because I think there's a bit of too much of a dichotomy on this panel. It's kind of this old guard, new guard situation. In some ways, I am part of the new guard, but I would like to think of our approach as a little bit more traditional historically. I think that, just when I think about the history of Kalshi, so Luan and I spent 4 years without a single product. We were just getting regulated by the CFTC, figuring out how this prediction market could live under the CFTC jurisdiction. And actually part of the reason, and so maybe this kind of ties to the exemption piece, like I don't feel very strongly about need for exemption versus not. What I do feel strongly about is a set of rules and laws that are set and that everybody has access to in a fair and equitable way. So I do feel very strongly about that. I am a very big fan of a level playing field. We as a company have had level playing fields at times and have not at other times in many ways. You got to think about a company that spent 4 years getting regulated And then, the day we got our regulatory license, the prior administration called us and said, actually, like, out of the 20 products you are intending to list, we're going to let you do one. So imagine the conversation I had with Sequoia and our investors, like, actually, the thing I promised you, not happening. But, and then we had to actually, to be clear, when we got kind of prevented from, and there have been exemptions in event contracts historically. Today, Kashi operates, we only have one exemption, which is sort of some swap reporting things. It's kind of irrelevant, but like, and I believe CME has it. I think QC has it. I think pretty much every exchange that does fully cash collateralized swap stuff has it, which is fine. I think everybody should have that one. But our answer was actually like suing the CFTC to actually figure out what the actual law is, which, we disagreed on the legal merits, and it seems like we were right. And then it's fair game for everybody to compete on a level playing field. So that's something that we do feel very strongly about. And I do share sort of like, it's a bit weird. I'm in this position where like, I do, we're very aggressive as a company. I think anybody here would agree. And we push the boundary of financial markets pretty hardcore. But when you think about it, like it has to be pushed in a way that is sort of accessible to anybody, but it also has to be pushed in a way that's sort of durable. And we really care about that. Because we were trying to tell you right before this, like, there has been a lot of companies that have sort of showed up and like things have gone, amazing. Then they went haywire, and then these things have gone, pushed back 5, 6, 7 years back. And that's not the type of organization we want to build. And in some ways, like, I kind of agree with both sides here. Like, I think there is a path. I do think the path will take a little bit longer. In some ways, should take a little bit longer, should take a little bit more conversation. And should be a little bit more deliberate about sort of means of access for everybody. We want you guys to sort of compete in these markets. It's funny because over the last few years, every time we had a new idea for a new product, we'd call Tribute at ICE, we'd talk to some of the people at CME, at NASDAQ, and they would tell me like, oh, well, here's kind of the 5 different times we thought about that. Here's all the issues and why we cannot do it. And like, I feel you guys, like, I think it is a very real issue today. So 4 years from now, hopefully we sit in a place where like we have rules that enable all these innovations, but you guys are competing with us on a level playing field. So,
Thank you. We're going to move on to 24/7 trading because we touched on it a little bit. And, there are some markets that already trade 24/7, but getting the input from the panelists today about the challenges, operational challenges, and customer protection involved in 24/7, and whether or not there are some markets where it's just not necessarily a great idea. Arjun, you want to kick off with 24/7?
Sure. So, I mean, we operate 24/7 across roughly about 130 jurisdictions. So spot, margin, futures. And I mean, we've proven that it can be done pretty successfully, in terms of like our volume per day. Again, we've taken a regulatory approach, compliant custody, segregated accounts, margin, et cetera. And then we built a lot of automated tools in order to do that. I think, the reason we had to do that was for us to be able to just, the basic first principles is just knowing who our customers are. Like, retail exists all over the world. And so in order to comply with the rules in each jurisdiction, you build some of your own software as well as using off the shelf software. I think what's really great about another hat that I wear is on the venture capital side is that, to his point earlier, he said that you go ask the folks that have been doing it for the last, 20 years, how do you do this? And the first thing they say is it can't be done. You go ask a venture capitalist that's investing in any of these guys or myself, and we have like an irrational passion that we think we'll figure it out. And that's the way that we figured out 24/7 trading in all of these jurisdictions is literally, okay, what are the rules that we need to comply with? What are the, the securities versus commodities rules? And in most jurisdictions, it's the same regulator. And so we've just continued to modernize that. And we're hoping to do the same thing here between the CFTC and the SEC.
A quick comment, and I agree with the comments. I think that you said it, Jill, product specific, I think is kind of what we're going to look at for 24/7 at CME, because right now crypto, you could say that they have a reoccurring cash market that's going 24/7. A lot of other products do not. So when you look at some of the ad communities and things like that who actually regulate the CFTC, which is our jurisdiction, there would be a lot of people in the country that produce product that would not want markets on a Saturday afternoon, and somebody, high frequency trader or other participants trading those and potentially distorting them without a cash market or the ability to participate. Secondly, you have to look at the cost to the firms that have to staff up in order to do 24/7. That's a pretty big cost, and they're trying to figure out what does it mean to them as far as staffing up these firms then, and very little business coming about it. Yet they have no choice because their competitors probably will. So we're already in a very difficult spot today with the amount of FCMs, futures commission merchants, that are going down by the second because of rules, regs, and other things. We need to increase that pool, not shrink it, and that could potentially accelerate that type of activity. I do think 24/7 is coming. I've said it for a long time now. I do believe that is the world that we're going to live in. And the market's going to demand it. We're all going to have to figure out how to get there. So I want to get there, but I want to get there in a very thoughtful way. And I think the best way to get there, for the way I see it, is through the crypto markets, because of the cash market that does participate around the clock. So I think we can do that, and then we'll see how it goes, and then we can go maybe on to the next asset class. But just to say all asset classes go 24/7, I think could be a detriment to a lot of producers and other people on the commercial side of the marketplace.
Yeah, so I agree with Terry. I think that if I went back to Chicago today and said, "Oh, Terry said that, SOFR options are going to be open 24/7," I'd have a mutiny on my hands. And I don't think that there's a ton of demand for SOFR options trading on weekends, quite frankly. Obviously, there's a ton of demand for retail products to trade 24/7, and I think that we'll get there. But when you move to 24/7, it's essential that you're able to move collateral 24/7 as well. The initial discussion when 24/7 was discussed by some of the larger exchanges was, "Oh, well, you can just post extra margin for the weekend." I said, that's not how it works. There's this thing called the crypto market where this is pretty figured out, and you can move your collateral all the time. And so it's critically important that we use tokenization and the right kind of tokenization, not tokenization that introduces additional counterparty risk, to facilitate 24/7. And so that means both cash, stable coins, tokenized treasuries. And the other thing that crypto exchanges are doing that traditional exchanges are not doing is accepting in-kind margining. And that's critically important, I think, for progress on the innovation front. I mean, CME should be allowed to accept Bitcoin for collateral if they want to, for Bitcoin, especially for Bitcoin futures. It's the most efficient collateral there is. And of course, this tokenization opens up the possibility of in-kind collateral for all sorts of products, right? You could imagine in-kind collateral for treasury futures in the form of tokenized treasuries, or for single stock futures contracts or single stock perpetual futures contracts, and accepting the tokenized form of that collateral. I think that that's all a big opportunity as we move forward, but also something that's essential to maintain the resilience of the markets when we move to 24/7.
First of all, I think the market should decide what products go 24/7 and no regulator. But beyond that, so I probably have pretty broad agreement on the panel. But to Don's point, the clearinghouses, traditional clearinghouses, are only allowed to accept fiat currency and G7 treasuries. And as you know, when we take your US treasuries, we're forced to discount them. The assumption is that we cannot liquidate in a crisis market a US treasury and convert it to fiat in order to bail out a company at 100 cents on the dollar. We have a lot of my colleagues up here on the panel, and a lot of us have been talking behind the scenes about, and Don's company, how to do tokenized collateral. But there's kind of this assumption in the crypto market that stablecoin equals $1, which A stable coin to us is an IOU for a treasury, and the treasury itself, we're not allowed to accept at 100 cents on the dollar. So it's definitely a discounted form of collateral that I don't think the regulators have yet been able to stress test to figure out what should that discount be.
Does anybody else want to touch on 24/7?
I'll cover, I mean, first of all, moving to 24/5 for the US equities markets is a big step. We're very excited about it. We want to make sure, and we've been working very closely with the SEC to think about all of the elements of that. So it's not just ATSs. Right now, ATSs are allowed to trade 24/5, and they do, but they do not have central transparency. And the resilience element to them is not quite, they don't have the same obligations. A lot of them have become much more resilient, but they don't have the same obligations. So I think that what we've been really focused on is making sure that if we're gonna bring the markets 24/5 on exchange, that we bring and bring all of the elements of those exchange operations into a 24/5 environment. And I think that we're working very hard with the industry, with issuers. I think we have to remember that stocks are not commodities. Stocks are companies run by people. And there are corporate actions and other things that occur during any sort of given week in a stock that need to be thought through as to how to manage those corporate actions in a 24/5 or potentially 24/7 environment in the future. I think that's something that's really, really important, that we always remember that the issuers do care about the trading of their stock, and they do have to be able to sleep. So we have to figure out how to make sure that happens in an elegant way. Also, the U.S. market hours are U.S. market hours. The 9:30 to 4 market hours are things that I think that currently the institutional community really finds very important. So how can you maintain that with an open and a close and then still allow for non-U.S. hours? And then the last thing I would say is not all stocks are liquid enough to have and support a 24/5 environment. We have 4,000 listed companies just on NASDAQ and another 2,000, I think, on New York or more. So more, sorry. I apologize, Jeff, or more. So, so you have to make sure that you're really thinking about the liquidity characteristics of the stock. And I agree with Jeff, it should be up to the market to make those determinations.
Shane?
I'll briefly chime in. So this goes, Terry, you saying that you would, how you would have to staff up for 24/7, and Adina, you saying how 24/5 is like this. Yeah, your firm would have to staff up.
Not us. I mean, my clearing.
Yeah, the clearing firms, just people in the ecosystem. Yeah. And I think that just underscores this idea of disruptive innovation in finance. Going back to this idea that, say, we want the regulators to employ exemption at their discretion to enable innovation, and how some of you guys may argue that leads to not a level playing field. I think that it's important to make a distinction between exemptions enabling a company to do something easier and get to market in a more less burdensome way and have more competition, to what I actually think it is, which is enable American companies to adopt new technology, of which the technology is superior. When you look at a blockchain, everything trades globally 24/7 inherently. You don't need to staff up. You don't need to go and have different people go and have people work weekends. So in a way, and I understand the pushback to it, but it's kind of a tale as old as time, where it's not that it's not a level playing field amongst competitors, but rather about the technology. And I understand that's difficult for legacy incumbents, but you guys will be able to compete in it, and I wish you well. Not that it will be easy with the new technology, but at the same time, it's totally possible. And I think that if we can all go and just agree, hey, there are benefits to blockchains, people can get on the same page in terms of how that can go and alleviate some of the difficulties with the traditional architecture.
I'm going to quickly turn to perpetuals, which is our last topic of the day, and I want to give everybody a chance for concluding comments. So I know there are different issues surrounding listing of perpetuals, so if anybody wants to address that topic, I'll open the floor. Don?
Yeah, so my view is that perpetual futures should just be eligible for listing in the United States. There's been a long-term, a long-held view that perpetual futures are not futures, that they're swaps. I think that that's ridiculous. I don't think it serves the investing public to force force them onto offshore platforms in order to trade them. The obviously futures contracts are contracts for delivery, which has been often cited as a reason to not permit perpetual futures. But of course, we permit cash settled futures, and contrary to popular belief, cash settled futures are not a delivery versus cash. It's just the future settles and it settles where it settles, and the variation margin has moved as it moved, and that's exactly how perpetual futures work. So I don't think that this is a big leap. I think that it's very clear based on the volumes that we see in the rest of the world that people really like perpetual futures. I think the time is now to let exchanges list them, and not in some kind of bastardized, long-dated futures contract that confuses everybody.
I'd just add that, I agree with Don. I think thanks to the CFTC's thoughtful approach, we at CBOE are launching perpetual futures on Bitcoin and Ethereum. Those are products that typically would have been traded offshore. So it's, I think, a good example of how our regulators can actually help support innovation in a constructive way. And so those products now will be traded on a well-regulated exchange subject to the CFTC's rules and jurisdiction and all that comes with that. So
Again, I think that Don is right, but a futures contract by law is defined as a contract to expire at a date to be determined, whether it's cash settled or physically delivered. There is no legal definition on a futures contract and how it's defined. A perpetual in of its name is defined as it never ends. And you just said it, a bastardized futures contract that could have a 2-year perpetual, 3-year perpetual, and we'll call it you could essentially call it a perpetual once you go past a certain time. So I think we need to have clarity. Once again, this is a good reason why this panel, you got to have clarity, because if you're going to have perpetuals, then you better change the definition of a futures contract. Because today it doesn't fit in the definition of a futures contract by law. So I think that's really important. And there's also other contracts, whether it's crypto, and I don't disagree with Craig. I think that you could probably easily do perpetuals on crypto. There's other products that need that mechanism for physical delivery to happen, and that price so you know that you're going to get that physical delivery, whether it's on energy, whether it's on an ag product, and those producers and consumers and commercials of the product, they want that physical delivery mechanism for price convergence, whether it's a cash settled or it's actually a physically delivered. Jeff has a contract that is priced off of my physically delivered contract. That's the way it works, right? So that's how the pricing mechanism, and they want that physical delivery. I don't believe perpetuals would be very successful because no one's clamoring for them in certain asset classes, but they are in potentially others, such as crypto and that. So I think, again, we either better define what a futures contract is for starters, and then we have to look at what contracts should be perpetual, because all of them may not fit. And you could hurt the people who produce food in this country or produce energy or other products because they don't want them.
Okay, I'm going to turn to concluding statements from everybody. I'm going to start with you, Arjun.
Well, first off, excited to be here. I don't think I would have said this, that I would have been excited to be here 2 years ago. We're a worldwide business. There was a vision that, Chairman Atkins had brought up about like the super app. And I think the word super app doesn't necessarily mean everything into one application. It's more that you have access to multiple products, multiple assets, collateral in some cases. And that's, the vision of what we want to be able to see, not just here in the United States, but all over the world. And, and while we are talking about innovation exemptions and we're talking about, clarity, at the same time, you can see a lot of the companies we are, we do have our licenses, right? So, broker dealer, FCM, who knows what's going to happen in the future here in the United States. Same with, UK MTF, EMI with CBI, and now MiCA. Part of, I think, what we're, very excited about with the House, the Senate, the White House, and the regulatory nature here is that at least we're talking about it. And it's not something that we've seen for at least 10 plus years. And so while we hear some of the frustrations and probably on both sides, I think we're probably the most excited about like what market structure is going to look like, and then also what the convergence of a lot of these asset classes coming together is going to look like, not just for ourselves and our platforms because we can get better, but we can serve. Our belief is that we can serve our customers better, because to Shane's point earlier is that we're able to do more with less, and what that really means is that we can actually provide more services, more of the capital back to our customers.
Well, again, also very excited to be here. I'll try to keep it short, but the kind of thing I was thinking about, so free markets are a great thing. I think we all agree on that. Free markets are great. They're a powerful driving force for economic prosperity in America, but they're also a privilege. We have to handle them with sort of caution, and we have to be deliberate when shaking them up. At Kalshi, I think we're really humbled to have contributed quite meaningfully to the expansion of free markets. Unfortunately, in the last few years, that expansion came with a heavy toll. We had to fight for every single inch of growth. I would even say had to fight for a right to exist. But we're really proud to be here and sort of have made it through it. Today does really feel like a new era. It feels like we can finally work constructively with regulators, but also the rest of the industry, to really figure out how to expand financial markets and incorporate all these technologies that are coming our way, while ensuring sensible regulation, customer protection, and market integrity. I really want to thank Chairman Atkins. I don't know if you're still here, for his leadership, and Chairman Fan for your leadership as well. The staff that's going to have to do all the work after this panel. And thank you all for hearing us out today.
So it's a very exciting time to be alive. And I think it's important that we position the United States to take advantage of all these innovations, technological advances that have happened, and bring them into the market so that the innovation, it happens here first. At the same time, it's important to do it thoughtfully. It's important to distinguish between, as I said, tokenized IOUs and actual assets on blockchains. That's an example of the type of critical thought that needs to be given to these innovations, to any kind of innovation exemptions that are granted. And I think that, as we think through these opportunities to innovate, it's important to bring things back to first principles and ask the question, for instance, do we still like Reg NMS? If we don't like it, let's revisit it, but let's not do some special carve out that exempts some people from Reg NMS and not others. But I think that if we approach these innovations in a thoughtful way, we have a ton of opportunity to lead the world and in implementing these in the right way.
Thank you again for inviting me to be with you today. I thought this was a great exchange, and I learned a lot myself. I'm reminded of something, which is that, first of all, I think everybody on this panel today is with an organization that is intensely competitive and innovative and has shown over many, many years the ability to adapt and evolve, and in many cases even self-cannibalize our existing businesses, products, and market structures. We've proven that time and time again. And I'm reminded of being here a few years ago when my daughter-in-law graduated from Georgetown Medical School, and the dean of the medical school sent everybody off, and he said, "Remember the patient, the patient, the patient." And if I could leave with one message today, it would be, let's work together to, encourage innovation and encourage competition, but don't forget the customer. Protect the customer, protect the customer. So everything we do, however we do it, let's protect the customers.
I do want to thank Chair Atkins and Chair Pham. This is, in my 32 years, is I think we think only the second time that this has been an opportunity for us to come and really talk across regulators like this. And we're really excited about what both organizations are really focused on here. I think we also have to accept the fact that technology and innovation are happening at a rate and then accelerating at a rate that we've never seen in our lifetimes. We think that some people think that the next wave of technology innovations like the dawn of the internet, I think it'll make the dawn of the internet look like it's really slow. And so to have an opportunity to work together across platforms with the regulators and with investors to figure out how to open the aperture for them, for investors, how to give investors more choice, but also to do it in a responsible way that protects them appropriately is a moment here where we have these new technologies coming in that can allow us to do great new things, that can globalize markets and open the aperture for new asset classes. And yet we also have to think about, as you said, always remembering that it is the investors with their hard-earned earnings that we're here to protect while we provide that innovation and even deepen the pool of liquidity even further in the United States. So we're very excited about this collaboration that you all are putting together. We think that there can be a really thoughtful way to bring markets to, further forward, and we're just excited to engage with you. So thank you.
Well, first of all, thank you very much for having me, and I want to thank both chairs for allowing us to have this panel today. And I will say that, Arjun, maybe nobody saw you sitting here 2 years ago, but I got to tell you, I'm really happy you and Tariq and Shane are sitting at this table today, because that's how we continue to evolve. If we sit here with just the people that have done it historically over the last several years, and I've been in this for 44 years, and I know it's hard to believe, but 44 years I've been in this business.
44 years old.
But it's really wonderful to have folks like yourselves up here and participating in the discussion about how we go forward. I think there'll be a lot that you can get done, but I don't want you to be disappointed. There's a lot we're never going to get done. And I think that's just a realistic nature of regulation. And the protectionism of the client, the patient, as Craig referred to it as, is really, really important, because without that, we will have nothing for the future. We will have everything for the near term and nothing for the long term. And that's what happens. There's a lot of us that sit up here right now that had the undubious task of sitting around during Dodd-Frank when the world was blowing itself up, trying to explain it was not the platforms that were the markets went bad. We were the platforms that helped the markets continue to go forward as everybody else on bad behavior was happening. So I think that we've helped set the stage for continued innovation in other ways, other than just by innovating products, but how about by creating an infrastructure or a fabric for the country in order to allow for innovation. So I think traditional exchanges can do that. I am massively excited about the future, massively excited. I'd love to be 20 years younger, not for and to hang around this world that long, but just to trade markets like that, because I think they are so exciting. I was on a T-Rex market all weekend like a junkie. I was in Las Vegas with a bunch of clients. Zeno never saw me because I was on his platform the whole time screwing around. Anyway, but it is really interesting what's going on right now as far as the markets and the access to markets, what you folks are driving as far as the retail access. The ability of technology, artificial intelligence, which is leveling the playing field. Sometimes regulators, Jeff said it earlier about, don't let regulators make the decision, let the customer make the decision. Artificial intelligence will help that process come to fruition. So I'm really excited by that. And then again, the last thing I will say is the wealth transfer that's happening in this world over the next 20 years is going to be massive. We need to make certain that the platforms they have there is a platform that they can feel comfortable participating in and at least have a fair opportunity to move forward. But we will never have that unless we have innovation and newer people coming into this industry. So I thank the three of you especially, but it's always great to have up here with my colleagues and Jill and Jamie. Thank you very much for hosting a very nice panel. Thank you.
Harry, you failed to tell the audience whether you made money or not this weekend.
You made money. I broke even. A lot of fees over there, buddy. People bitch at me all the time about the fees. I got to take the opportunity. A lot of fees on that Kelsey thing.
Well, I want to thank both chairs. It's an amazing thing to have two agencies that are led by people that want to work together and make life better for the consumers. And for staff, Jamie and the staff, there's been a lot of laws written since the 1934 Act. And so we've highlighted a few here that have put limitations on the market. And it's going to be a thankless job for staff to try to help grind through this in order to make it a better environment. I would just say one thing, and Don has been a friend of mine and a colleague for a long time, and one of my biggest customers. But we started the conversation talking about a series of issues that really are impacted by Reg NMS, and we ended with perpetuals, which are really called that because nobody wants to have a swap because those are regulated by Dodd-Frank. And it may be too hard for this industry to reopen Reg NMS and to reopen Dodd-Frank and the rulemakings between two agencies that have been working on those issues for, I guess now more than a decade and multiple decades. It might be easier to actually just say we have an innovation idea, call it an exemption or whatever, that just fixes some of this stuff. So I don't want to get hung up over form over substance. I think the point you are making, Don, though, that I do agree with, which is whatever these quote unquote exemptions are, it should be unilateral for everybody in the market. It should be technology agnostic. If you can do it, with an Oracle database as opposed to a blockchain, great, have a party. But in any event, I don't envy the staff, but I look forward to putting the resources of my firm behind you to try to find a path to improve some of the regulatory landscape as quickly as possible.
To echo some of the things you guys have said, I want to express immense gratitude and respect to both chairs, my fellow panelists, the moderators, all the staff of the regulatory agencies, everyone in this building. The rhetoric that we read now when we read these articles on the SEC and CFTC website is such a stark contrast from before, and it's inspiring, it's exciting, and it makes me proud to be an American. And Perry said this too, but this panel is really what America is about. You have the legacy juggernauts, you have the rising stars like Tarek, Arjun, and myself, and you have the regulators who are here listening to us and going to make the rules that we have to follow to go and innovate. And it's up to everyone to be responsible, but be aligned about, okay, we're going to try and build some new things. We're going to try and experiment with new ways of doing things that we think there's either latent demand for or that there's demand for already that we can make it better for. So I just end things off by saying I'm really excited to build things together with you all.
Thank you all for all of your comments. I think as we started out today talking about how important all of these issues are, and your attendance here just proves that this was a really important discussion for the regulators to have. So thank you all.
Yeah, just a quick thanks to the panelists. Jeff will grind, Tarek will work on those hourly certifications for you. A special thanks to my CFTC adjacent partner here, Jill Summers. We'll be joined by Commissioner Mark Ueda for remarks, and then we'll break. You guys want to?
All right, so how about another round of applause for our excellent panel? Hopefully I'll keep these remarks short, but I want to thank the panel for sharing their ideas with us today, as well as all of our staff for putting this event together, and all of you, especially. This is, I think, the most crowded I've seen our auditorium in quite some time. So innovations such as blockchain, AI, and DeFi promise to disrupt our markets in ways that are exciting to discuss. But equally important, though perhaps less exciting, is discussing how regulatory agencies should align their oversight when new ideas cut across jurisdictional lines. Innovation rarely respects jurisdictional lines, and they often do not fit neatly into the statutory distinctions between securities and commodities that were written decades ago. Yet the regulatory system is in which we operate is reliant on clear borders for regulatory efficiency. When innovation crosses this line, one might call it regulatory disruption. Regulatory disruption can result in overlapping oversight, confusion, and ambiguity, and have their own negative consequences. So let's go back to the past to talk about how this may be dysfunctional. And I can illustrate this with an example. For a long time, there was CFTC Rule 4.5 under the Commodity Exchange Act that provided an exclusion for registered investment companies, mutual funds and ETFs, that happened to use a limited amount of commodities futures. These mutual funds and ETFs were already subject to comprehensive SEC regulation under the Investment Company Act of 1940. The CFTC had reasonably concluded that there was no need to layer on its own commodity pool operator requirements in addition to the SEC rules. But that changed in 2012. The CFTC moved to essentially eliminate that exclusion. Under amended Rule 4.5, an SEC-registered investment company using derivatives beyond a very low threshold, whether for hedging or for investment, was required to register with the CFTC as a commodity pool operator. This change was claimed to be necessary to bring oversight of swaps into the CFTC's remit after the Dodd-Frank Act. In practice, it was a jurisdictional land grab. Mutual funds have long used derivatives as part of ordinary portfolio management, particularly for fixed income, where derivatives can often trade more easily and cheaply than the underlying securities. Given the SEC rules on disclosure, reporting, governance, and risk controls, the new CFTC requirements did not fill any sort of regulatory gap. They duplicated regulation that already existed, and that was evident in the extensive harmonization rulemaking process that followed. Well, what did this mean for industry? It meant dual registration. Fund sponsors who were already SEC registrants now had to register with the CFTC. That entailed new filings, new fees, new compliance infrastructure. It meant duplicative reporting. Advisors had to build parallel systems to track, reconcile, and report essentially the same information in two slightly different formats to two different regulators. Finally, it meant conflicting requirements. The SEC and CFTC had different standards for record keeping, advertising, and the use of third-party administrators. Funds that found themselves caught between two sets of rules that were not harmonized. And all of this translated into real cost. Industry feedback at the time foresaw millions of dollars in incremental compliance expenses, costs that were ultimately borne by investors. Yet there is no evidence that the CFTC's overlay produced any incremental benefit in terms of market integrity or investor protection. So as technology continues to evolve in the financial sector, how can we avoid repeating this mistake? The CFTC and the SEC share responsibility for markets that are increasingly interwoven. The agencies need to look past technical definitions and focus on the functional aspects of the novel products themselves. What risks do they create? What practicalities already operate to mitigate those risks? How are remaining risks best addressed? And how can duplication of effort be avoided? Today's call for harmonization and a new era of collaboration from the leaders of both agencies importantly make the point that we should answer these questions before announcing jurisdictional claims. Where one regulator already has a robust framework, the other should think carefully before layering its own rules on top. We must remember the alternative tools available to us: information sharing agreements, joint examinations, and harmonized reporting forms that help us work towards accountability without imposing duplicate requirements. The benefits of a successful regulatory engagement are clear: consistent rules, efficient compliance, and investor confidence. The consequences of failure are equally clear: duplicative oversight, higher costs, and no discernible improvement in investor protection or market integrity. The pace of innovation in our markets is not slowing. It's quite the opposite. Today, in this administration, we have an opportunity to avoid the mistakes of the past and instead, together, build a regulatory architecture that evolves with our markets and new financial products, not against them, through a harmonized regulatory approach. So thank you very much for your time. And now, okay, it's break time.
Yep, we'll break until 4 p.m. So thank you, Commissioner Ueda.